Welcome, everybody. Off to a bit of a late start this morning. Thank you for hanging in there with us. We had some technical difficulties. It is one of those Monday mornings, but we are so excited to be here with everyone and to discuss what happened in the market in the first quarter of 2021 and what we see as being possible move makers in the market going forward in the year ahead. My name is Natalie Colley. I am an associate advisor at Francis Financial, and I'm here this morning with my colleague and teammate, the wonderful Alexandra Shepis. Al, do you want to say hello?
Good morning, everyone. Thank you, Natalie, for the introduction. My name is Alexandra Shepis, and I am an analyst at Francis Financial.
And together we form what we refer to ourselves lovingly as Team Shred, because we are both from the West Coast. So Team Shred is very excited to be here with everyone this morning. So let's go ahead and start with a really high level overview of what happened in the markets this last quarter. And as you can see from this lovely chart here, it was overall a very positive quarter. US stock side, it started out with a little volatility. If you recall the riot on the Capitol to get the year started, and there was some uncertainty over the handoff from President Trump to President Biden, as well as whether a stimulus package would ever be passed as was promised. So it got off to a bit of a shaky start right there in the beginning of January, but you can see that enthusiasm about the vaccine rollout and enthusiasm about the stimulus, as well as Biden's massive infrastructure package and spending plans, has really driven the market up so far this year. And the first quarter ended with US stocks up 6.35%. That vaccine rollout enthusiasm, euphoria almost also bled into international and emerging markets. And we did see a negative in the bond market, although the Fed has said they're not going to raise rates. We still saw bond yields rise, which sent the prices of bonds dropping. So as I mentioned, overall throughout the world, we just saw this great enthusiasm as we now have multiple vaccine options on the market. The US is doing a great job, and Al's going to talk about this a little bit more with their vaccine rollout, but wanted to point out a couple of areas here. So China, you can see China was just about flat for the year at a negative, or for the quarter at negative 0.2%. So recall that China was, of course, the first to go through the pandemic back in, December 2019, essentially, maybe even earlier. So by the second quarter of 2020, China was pretty much all the way through it. Even though there were no vaccines readily available at that time, China did a great job of really locking down the country and getting on top of the pandemic. So they were able to go through this wave of euphoria and able to return to a life that somewhat resembled normalcy really this time last year, while the rest of the world was struggling through the pandemic. So what we're seeing in terms of growth in China is more a return to normalcy, and what we're seeing throughout the rest of the globe is this continued enthusiasm in looking at the year ahead, seeing the light at the end of the tunnel. I also wanted to point out India, positive 5.2% there. So even though India is really struggling with the pandemic in this moment, still saw a lot of private equity investments in the first quarter moving into India, and still just a lot of this optimism. You can tell that the market is really pricing in future growth once we're past the pandemic, despite the horrific human toll and tragedy that is occurring in India at the moment. So just overall, this amazing euphoria across the world as we all look forward to life returning to normal at one point, hopefully later this year.
So let's take a deeper dive into U.S. stock performance, looking at growth versus value. So in the first quarter, we saw a reversal in growth versus value U.S. stock performance. But taking a step back, a growth stock is a company that investors believe will experience that faster than average growth. These companies are more likely to reinvest their profits in expansion projects rather than paying out dividends to shareholders. On the other hand, value stocks are mature companies that are primarily using their earnings to pay dividends. So compared to Q4 2020, growth stocks were outperforming value stocks in that fourth quarter. However, as markets continued their recovery in the first quarter of this year, we noticed the change. And in this graph, if you look in the top right-hand corner, year to date, we are seeing that value stocks outperformed growth stocks in small, mid, and large cap categories. We also see a very similar story looking at the time frame since the market lows beginning in March 2020, where small and mid cap value stocks were ahead of their growth counterparts. And while the impressive returns of U.S. stocks are great to see, it does come with a cost. Overall, U.S. stocks are overvalued compared to their historical levels, and are even more so after this robust performance that we've seen in the first quarter. So looking at this graph here, you can see that investors are willing to pay a premium to hold U.S. stocks. Looking at developed international, that red line there, and emerging market stocks, the green line, they have lower price per earnings ratios than the U.S. So on average, for every $1 of earnings per share that a company reports, investors are paying over 28 times that in price per share for U.S. companies. International stocks have lagged their U.S. counterparts for quite some time, yet it's important to note that they are cheaper, as we just talked about. So we could be entering a period of international outperformance in the coming years ahead, and even more recently now, as we are seeing international countries emerge from the pandemic. International stocks offer long-term growth opportunities, particularly if we look at the Eastern Asian markets, who appear to have had more success in subduing COVID-19 than the United States, which Natalie talked about earlier. And we're also seeing progress in Europe in resolving the Brexit standoff and increasing fiscal integration that could benefit that region as well.
So let's shift gears here and talk a little bit about what investors are thinking about and taking into consideration looking ahead and trying to use our crystal ball to figure out how news today is going to impact the market in the future. And there's a lot of really positive news out there. In fact, overwhelmingly positive news. However, even with a heavy dose of positivity, you can never fully get away from concerns and worries, particularly when it comes to talking about the market. There's always something to be concerned about. So we're going to get a little bit deeper into the global vaccine rollout and exactly where we are, get an update on that. We have some really strong unemployment numbers. It's fallen drastically. Talk a little bit more about that. And of course, government spending. The market is generally very excited about getting an influx of cash from the government. We're seeing a lot of momentum as we start the year, and that's anticipated to continue through 2021. But on the flip side, with government spending comes government debt, and there's some concerns about government debt, if left unchecked, leading to runaway inflation. So there are some concerns about inflation long term. But ironically, sort of the flip side is, in order to pay for some of this government spending, Biden is proposing some tax hikes in various areas, corporate, personal, capital gains. And so there are also concerns about what those tax hikes are going to mean, particularly for the bottom line for US companies. So some things to dive deeper into. And let's start with the most obvious, which is going to be, getting an update on where we are in this pandemic.
Yes. So for our update, as of last week, the total vaccines that have been delivered is 196 million. That is a lot of vaccines. 2020 was the year of the pandemic. I'm thinking 2021 is the year of the vaccine. And the percent of people over aged 65 that are in the US population is 51%. And of those aged 65, 82% of them have received at least one shot, or in many cases, the Johnson & Johnson one-shot vaccine. So we are just continuing to move onward and upward with the vaccine rollout in the US, which is really exciting because I know for myself, I am very much looking forward to returning to a sense of normalcy, albeit a new normal, of course. Looking at the number of COVID-19 cases that we have here in the U.S., after seeing the pandemic surge in the winter months, the U.S. is making considerable progress against the pandemic. As of last week, the official death count had reached over 567,000, while also surpassing 31 million cases in the U.S. We are seeing a steep decline in new cases as the vaccine rollout has slowed down transmission, allowing the economy to continue on that path of reopening across the U.S. And we are also seeing the 7-day moving average falling below 700 deaths per day. Looking back at January, that number was much higher at nearly 3,400 deaths per day. And as of right now, it's estimated that 2/3 of Americans have some immunity to COVID, whether that is from receiving their vaccine dose or from natural immunity. The U.S.'s latest average vaccination rate is 3.3 million doses per day, which again is just phenomenal news to hear. And assuming this accelerated pace of vaccinations, that if that continues with growing immunity along with better testing and therapeutic drugs, we expect the number of cases of COVID and deaths to continue to drop over the summer, which is right around the corner. And, again, hoping to return to a normal life by the end of the year.
Wow, almost 3.4 million doses per day. That is mind-blowing. Mind-blowing, the logistics of that. Wow. So let's talk about something else that the government is working on, and that would be government spending. Now, obviously, this is a huge driver of the market in 2020. There were several really big stimulus packages that were pushed through, and those were very helpful, not only to individual families, but to the economy. It helped us recover from the March lows in a record amount of time. And it's this type of big government spending that we really haven't seen in ever is really the wind behind the economy's sails in 2021, giving a huge boost to the market. And President Biden has the benefit of having, the blue wave in the Senate. So in the Senate race, the 2 Georgia seats that were up for grabs, both won by Democrats. And so the hope is that President Biden will be able to push through his really big spending plans um, without Republican support potentially. So let's dig into what these plans are a little bit closer. So on March 11th, President Biden signed the $1.9 trillion American Rescue Plan. So this package, of course, is already out there, $1,400 stimulus checks. He extended unemployment benefits an additional $300 a week, and that's up until September. He extended the child tax credits and expanded them in certain cases. He earmarked aid for state and local governments, also for some tribal governments, gave a lot of money to schools to help them with reopening, which we know is a really important aspect of getting the economy back up and running, because as children are at home, they need to have a parent home there to supervise what they're doing. And more often than not, it's the mother's role to do that. And so we saw a lot of women leave the workforce in 2020. It was pretty devastating for women in particular. So getting funding to reopen schools is really important to stabilize the economy and the workforce, get more people involved. And then, of course, the national vaccine program, which, Al, as you walk through those numbers, we can see has been extremely successful so far. And now the next huge initiative on Biden's agenda is this infrastructure plan. And this is, I know this graphic is a little overwhelming, but I love it because it shows the breadth and the magnitude of what he is proposing. So these are actually sort of, two plans here. He has his infrastructure plan, and then he has his family's plan. He came out with the infrastructure plan in April, and then just more recently came out with the family's plan and started detailing that. But let's start with the infrastructure plan. It is extremely ambitious. It's pretty cool in how broad and ambitious it is actually. So not only is it allocating funds for capital improvements to infrastructure, it's also looking to address climate change in the process, care for people with disabilities, long-term care for seniors, helping to improve infrastructures in schools, and also, and this is particularly cool, trying to address issues caused by systemic inequality. So he's throwing all sorts of, throwing money in a creative way at a lot of various problems in our society. So it's pretty cool package. And I'm actually going to read some of the bullet points in the package because it's just, there's so much in there. So revamping 20,000 miles of roads and highways, repairing 10,000 bridges, building a network of 500,000 electric vehicle charges. So that's part of that green initiative, ensuring public transportation revitalization reaches communities of color that have previously been impacted by things like, highways running through those communities, $300 billion to improving drinking water infrastructure. We know that has been a big problem, particularly in Michigan, replacing all lead pipes in drinking water systems, $300 billion into building and retrofitting affordable housing, universal affordable broadband service as well. So just some really cool stuff in that package. And then on the other side, we have that $1.8 trillion families plan. Some pretty cool benefits for low and middle income families, like national paid family and medical leave program that actually benefits everyone, childcare subsidies, extensions of several of these tax credits that we saw during COVID-19. A big part of this plan is also universal pre-K for 3 and 4-year-olds, and then 2 years of free community college. And those are just some highlights of what these plans are considering. So the big question, of course, is what are these plans going to look like once they're actually passed? Because there's obviously room for a negotiation in here, and we'll see if it can actually get passed. But the cool thing is, because the Democrats now have this very slim majority in the Senate, they're considering passing it through budget reconciliation, which only requires a majority and doesn't require that 2/3 majority that typical bills take to pass. So keep an eye on these spending plans. Either way, it sounds like there's going to be a lot of government spending, even if it's not these exact packages that we're talking about. So how is the government planning on paying for all of these plans? Well, one side is the corporate tax proposal. And at the basic level, it's increasing the corporate tax rate from 21% to 28%. That may seem like a big jump, but actually in 2017, the highest corporate tax rate was 35%. President Trump, in the Tax Cuts and Jobs Act, lowered that from 35% to 21%. So Biden's still not going back up to that 35%. He's landed on a 28%. So the biggest impact, I would say, for his corporate tax proposal is he's really trying to close corporate loopholes that allow US companies to offshore their profits and not pay taxes on them. So he's proposing a global minimum tax rate of 21% for US companies to deter them from, again, sheltering those profits overseas, and closing various loopholes. So taxing on book income, which is the income that corporations share to shareholders, rather than the income that they sort of devise after depreciation and a whole bunch of other incentives to the IRS. And also disincentivizing and sort of closing some loopholes that allow US companies to acquire or merge with non-US companies and then say, well, we're no longer a US company, we're actually a foreign company. And then the final piece is he's really trying to lean on other nations' leaders to help, to encourage them to similarly tax companies that try to say that they're foreign companies and not US companies. So mainly, you know, in general, closing a lot of those corporate tax loopholes for companies. The other piece that you've been hearing a lot about lately, likely, is his proposed capital gains increases. So this proposal would hike capital gains rate for those earning 1 million or more. And the capital gains tax rate, this is a pretty big jump. It would increase from the highest 20% right now all the way up to 39.6%. And if you add in the Medicare surcharge tax on top of that, that means the highest rate for capital gains taxes could be as much as 43.4%. Now, a couple things, you know, some commentators have been saying that this capital gains tax rate hike is going to cause high earners to just dump all of their stock in the market this year. You know, not likely to happen, or at least that's not the full story, right? So for those in that 1 million and above range, yes, there may be a little bit more turnover in their portfolios because they're trying to realize capital gains now, potentially before this goes into effect, and analysts are anticipating this potentially going into effect starting next year. But they're not going to just leave all of these profits in cash, very likely. Very likely these profits are going to have to be reinvested somewhere else in the market. So it's not as though there's going to be this huge exit from the market that's going to completely destabilize things. And the second thing to keep in mind is according to President Biden, this tax hike will impact 0.2% of Americans. So a relatively small number of people overall are actually going to get dinged by this. And so sort of keep that in mind, that this really only applies to people with income of 1 million or higher. So between these tax proposals, President Biden and his team are anticipating paying for the infrastructure plan and the families plan in 15 years.
So let's talk about inflation. Looking at this chart, it shows how inflation has actually stayed within a narrow range of about 2 percentage points, despite fluctuations that we have seen with unemployment across various years. So as Nally had mentioned earlier, right now there are some inflation concerns amongst investors, but those inflation fears may be a little overstated. But it's not to say that inflation spikes might not happen in the future. The pandemic has definitely created a sudden shutdown of sectors of the economy, including travel, food, hospitality, and leisure and recreation services. So it's likely that we will experience some sort of price increase in excess of the normal inflation trends that we've seen in the past. Vaccination, as it continues on its current course, it's probably going to create a sudden demand in many of these, hospitality and travel sectors. But it's important to note that some modest level of inflation is a sign of a healthy, growing economy. It means that people are, going out, they are spending their money, they're earning their paychecks, they are not keeping a lot of it set aside in a bank account. They're going out and helping the economy continue on that path of recovery. So in the near term, we do expect to see continued volatility in the bond market with some inflation concerns, but over the long term, we don't see it as a concern at this point. And speaking of bonds, we have seen bond yields rise, especially in the first quarter. The yields on U.S. Treasuries have surged to their highest level in more than a year from the lows that we saw back at the start of the pandemic, as the Fed decides to hold rates near zero for the foreseeable future. Again, encouraging investors to go out and spend their money and continue to grow the economy. And as this happens, we do see, again, a slight uptick in inflation. But despite these current unattractive yields that we are seeing with bonds, high quality bonds still play a really important part in an investor's portfolio. Those bonds are there to act as that cushion during times of market uncertainty. When we went back to the lows of the pandemic back March, April, May, we did see bonds returning quite positively during that time period. So again, bonds are there to act as that downside protection during any volatility. And they're also there to provide diversification in portfolios. So again, even though their yields might not be very attractive right now, still playing a very integral role in the creation of portfolios. And we are continuing on our way to recovery from an unemployment standpoint. Over the last 50 years, the highest unemployment rate was back in April 2020. And since the pandemic started, about 9.5 million jobs have sadly been lost. However, improvements in the labor market reflect the continued resumption of economic activity that had been curtailed due to the pandemic. So we do expect to see these unemployment numbers continue to tick downwards. Sales are increasing as the economy reopens. Yes, economic growth is estimated to increase due to the amount of fiscal and monetary stimulus combined with the continued vaccine rollout that we're seeing and reopening of all different types of businesses. Over the past several months, the country has experienced a somewhat uneven recovery with manufacturing and consumer spending. Those areas of the economy were actually surging during the pandemic. I know a lot of people were doing online shopping throughout the pandemic, while other parts of the economy did lag behind. But we do see the labor market as a whole continue on its path of recovery. Again, people are going out and spending, driving that GDP growth. And the National Retail Federation recently released its annual forecast and said that it expects retail sales to grow between 6 and 8% this year. So very, very strong, positive numbers that we like to see. And those percentages equate to more than $4 trillion in sales. So this robust outlook would be the U.S. economy's fastest growth in more than 2 decades. Pretty crazy.
Wow. So sort of like we said at the top of the presentation, a lot of positive news in the market. We expect to see the market, grow this year, but we also expect to see some intra-year volatility. So how can investors stick with their plan, and what should they be doing to prepare? And I think I sort of buried the lead there, which is to prepare. The best investors are going to be sticking with their plan, right? So I love this slide because we've been getting this question a lot, Al. In our clients and just people I've been talking to generally, friends, family, are worried about investing when the markets are at an all-time high. And so this chart is pretty cool because it shows you on the left, each of these lines, these bar graphs on the left, show you what happens if you were to invest $1 on just any old day in the market, any random day. And then the dark green bar, the forest green bar, shows you what happens if you invest that same dollar at when the market is at a new all-time high. And as you can see, there's actually a pretty big difference in growth. So at the 1 year, growth of $1 invested on just any old day, about 11.7%. Growth of $1 invested at an all-time market high, 14.6%. And then if you take that out to 5 years, there's a 7% year over year difference in your the growth of that dollar. So pretty cool to see that. And I think the general reason here is momentum. Once the stock market is at an all-time high, there's kind of that momentum driving it constantly higher. Important to just keep in mind that over the long run, the vast majority of years in the market are positive. So this chart, you can see on the x-axis are the years, and on the y-axis a return. And each of these bars represents the return each year in the market at the end of the year. And you can see vast majority are positive on the upward side, and really a small few percentage on the negative side. And the majority of those are sort of, in the 1920s and through the 70s. I mean, just not very many negative years more recently. Warren Buffett likes to say that he invests assuming that if the stock market were to close for the next 5 years, that would be just fine. And that's a really, really logical outlook to take.
And it is also very important to stay invested, which, we totally get it. It can be a little scary, especially when we have a global pandemic hit the markets and with all of the volatility that we saw. But what this graph is showing is that in 16 of the last 20 years, U.S. stocks ended up with gains for the year, despite really large intra-year declines. we look back at 2020, we did see that sharp decline of 25% from the coronavirus. But US stocks ended up with gains of over 20%. So if you were able to kind of put your noise canceling headphones on and not pay too much attention to the swings in the market, you would have ended up with gains of over 20%. And volatility is a normal part of investing, which doesn't make it any easier. So while tumbles may be scary, they shouldn't be surprising. And maintaining that long-term focus can help investors keep perspective and to stay invested.
Yep, we've been saying a lot that it's not if the next market correction will happen, but when.
But when. All right. Well, thank you everyone for joining us today for our quarterly webinar. And our next webinar will be with Paul Stages and Peter Vellum, our Francis Financial colleagues. And that will take place on Monday, August 2nd at 8 a.m. And we love to stay financially and physically fit. Every other Thursday at 1 p.m. Eastern Time, we do virtual workouts with Dr. Laura Miranda, and our next one will be this Thursday, May 6th, and then the other one after that, May 20th. So if you're interested in joining us for a really fun yet also great workout, please email clientrelations@francisfinancial.com, and they will gladly send over the Zoom link to attend.
Yeah, those are very fun. So, all right. Well, this has been a wonderful morning sharing the market update with everyone. Thank you again for joining us, and we look forward to seeing you next time.